has rallied over 25% in the last 3 days. This is the biggest 3-day gain in about 25 years. So why is this important and will it last? I'm here with Thomas George, Portfolio Manager of the TD Energy and Resource Funds. Hello, Thomas.
Hey.
So have you ever seen this before?
Yeah, so this is wild. It's a wild ride, and obviously 25 years. This is probably one of the most dramatic rises we've seen in oil. And really, what it really highlights for us is how much speculative interest there is in the market, and more specifically, how much pessimism there is in the market. So I think this was a shakeout. Ultimately, there were some good news stories, but if you correlated the news stories in relation to how much the move was, it's completely outsized, and in our view that is really an indicator of how much speculative interest is currently in the market.
So what are some of the things that are really going on here?
Right, so what I would highlight is that over the last 15 years we've seen a significant increase in the speculative interest in commodities across the board. So the way I like to think about it is what it really does is it makes that ride that much more volatile, and it really. So
what are these, like hedge funds, or what do you mean by that?
These are players that are financial participants, right? They're not exchanging a barrel of oil. These are financial participants speculating on where the price of oil could go. So that makeup of the entire commodity market is much bigger than it ever was. So that ultimately takes the highs much higher, lows much lower. So ultimately it creates a much more volatile environment, and we've seen that today. And what it really shows too is that you can see the nature. So this recent rally is really a short covering rally. A bulk of that has been a short covering rally, and it really shows you how much pessimism is built in the market, how much negativity, and when that gets unwound by a few good news stories, you really get a nature of how negative the market overall was.
So do you think the week-to-week news, like for example OPEC talking, not talking, and those sort of things, and the barrel counts that we get, are they swaying the market as well?
Well, no. So the way I think about these things is, I can point to any one of these news stories. I can point to the similar news story when oil was coming down and the market just said, we're not thinking about it. What you really get here is when the pessimism hits an extreme point, and you really get that inflection point where people are like, whoa, this is significant. And the way we think about it is really simply, there's a lot of parallels that are driven to today's crisis compared to the episode in '86. And I'd say the critical difference we have here today, and why these sorts of news stories, be it OPEC, be it the energy agency in the U.S., taking down U.S. production, is that spare capacity in the overall global system. Back in 1986, there was over 10 million barrels per day of spare capacity. That's significant. That was a significant overhang. Today, that's less than 2 million. So just to put into context, if you got the right players at the table and said, we've had enough of this, the market could correct quite quickly. And I think that's really what spooks participants that have taken a negative tilt on the oil price.
So are you expecting more volatility?
We expect the volatility regime to remain the same, which is high, and we would really say, it's a good time to remain in high quality companies with low leverage.
And I guess if you're looking to purchase, now might be a good time to start looking.
Yeah, we always believe that it's a good time to start looking when you have a fundamental belief in where the long-term oil prices should be. We always believe if you're below that, that's a good time to accumulate shares.
All right, thank you very much, Thomas.
Thank you.
I've been joined by Thomas George, Portfolio Manager of the TD Energy and Resource Funds. I'm MaryAnn. Thanks for watching.